Imagine a world where the stock market hits a record-breaking all-time high on the same day the last major recruitment firm in New York City quietly turns out the lights. This is not the plot of a dystopian thriller. It is the statistical reality of the 2026 market anomaly. For decades, the logic of the American dream was simple. When the economy grows, people get hired. But in early 2026, that fundamental law of gravity has been repealed. The United States is witnessing a profit without people era that has left economists stunned and millions of workers in a state of terminal uncertainty. While corporate balance sheets are gleaming with unprecedented efficiency, the traditional connection between human effort and economic output has been severed. This report explores the terrifying mechanics of a world where the engine of prosperity no longer needs a human hand on the wheel. The numbers emerging from the first quarter of 2026 tell a story of two different Americas. On one side, the U.S. gross domestic product is projected to skyrocket by a massive 5% this year, driven by a surge in machine-led productivity. On the other side, the Department of Labor is flashing a red alert. The latest Job Openings and Labor Turnover Survey, or JOLTS report, shows job openings have plummeted to just 7.15 million, with hiring rates hitting their lowest levels since 2013. Analysts now warn that the unemployment rate is on a collision course with the 6% threshold, even as the economy enters a period of high-octane growth. This is the heart of the anomaly, a decoupling of productivity from labor that has never been seen in the history of industrial capitalism. To understand why everyone is being fired while the economy booms, one must look at the shift from generative AI to agentic AI. In 2024, AI was a tool that helped humans work faster. By 2026, AI has become the worker. The agentic era is defined by autonomous software systems that don't just answer questions. They execute complex workflows, make financial decisions, and manage entire supply chains with zero human oversight. In May 2026, a milestone known as the coding Singularity is expected to occur, where leading-edge agentic models reach human-level performance in specialized domains like software engineering and data analysis. This is driving a massive wave of silent purges. Corporations are no longer just downsizing. They are fundamentally re-architecting their operations to be AI first, meaning human headcount is viewed as a legacy cost rather than an asset. The stock market has already picked the winners of this transition, and the results are surprising. The legendary Magnificent Seven, the tech giants that dominated the 2020s, have officially been renamed the Lag 7. Stocks like Apple, Microsoft, and Nvidia, while still massive, have started to lag behind the broader S&P 493. Investors are pivoting away from the creators of AI and toward the companies that effectively implement AI infrastructure to slash their own payrolls. The new batch of winners in 2026 are the firms that have successfully traded 10,000 salaries for a single data center lease. The structural shift has made the K-shaped economy more tangible than ever before. Asset owners are seeing their wealth explode as corporate margins expand, while the working class and middle-tier knowledge workers face a collapsing labor market. Adding fuel to the fire is a precarious macroeconomic backdrop. As of January 2026, the effective tariff rate in the U.S. has surged to 18.5%, a massive jump from the 3.5% seen just a few years ago. While these tariffs were intended to bring manufacturing jobs back to American soil, the opposite has occurred. The high cost of imports has squeezed corporate margins, forcing companies to accelerate their automation plans even faster to stay profitable. Manufacturing employment has continued to decline, losing 68,000 jobs in the last year alone, as firms prioritize hyper-automation to offset tariff-induced price hikes. The economy is essentially in a state of stagflationary growth, where productivity is high, but the cost of living for the average person is rising alongside the risk of losing their job. The psychological impact of this anomaly is creating a low-hire, low-fire equilibrium that feels like a trap. For those lucky enough to still have a job, wage growth is softening, and the return-to-office mandates have become a tool for quiet quitting by the employer, forcing workers into rigid schedules to encourage them to leave without the need for a formal layoff. A Monster Work Watch report reveals that 52% of workers expect nationwide layoffs to increase throughout 2026, and a staggering 49% fear that AI is a direct threat to their specific industry. The confidence of the American worker has hit a decade-long low. Even as the television news anchors talk about the great 2026 boom, this boom is increasingly being powered by what analysts call the new intelligence layer. In 2026, the cost of expertise is trending towards zero. Tasks that previously required a $150,000 a year junior analyst are now being handled by agentic models for pennies on the dollar. Large U.S. tech companies have tripled their annual capital expenditure to over $500 billion, with most of that money flowing into AI-optimized servers and energy-hungry data centers. A shocking reversal of historical trends, AI-related investment contributed more to U.S. GDP growth in 2025 than consumer spending did. The American economy is no longer a consumer-driven engine, it is a machine-driven one. If the economy can grow without the consumer having a paycheck to spend, the entire social contract of the 20th century begins to unravel. The K-shaped divide is further widened by an energy crisis. The massive data centers required to run 2026's AI agents are consuming staggering amounts of power. OpenAI alone has plans for data centers with 25 gigawatts of capacity. This demand is driving up electricity prices for ordinary households, creating a secondary affordability trap. The average American is being squeezed from both sides. Their job is being automated by a machine that is also making their utility bills unaffordable. This has led to a surge in social polarization as the November 2026 midterm elections approach. Discontent is simmering under the surface of the rosy GDP numbers, with 58% of workers reporting that their pay has already fallen behind the rising cost of essentials. In this environment, the very nature of work is changing. The only pockets of growth in the 2026 labor market are roles that explicitly mention AI skills, which have grown to represent 20% of all tech roles. However, even these roles are under pressure. The May 2026 coding Singularity suggests that even the people building the AI are now being replaced by the AI itself. We are entering the era of the specialist, where only those who can manage high-level agentic workflows are safe. For everyone else, the economy is booming in a way that feels like a slow-motion collapse. The 250-year reset is no longer a conspiracy theory. With the U.S. celebrating its semi-quincentennial in 2026, many believe the old economic system is simply being retired to make way for a fully automated future. Institutional decay is also playing a role in the anomaly. The Federal Reserve faces a stagflation challenge that has divided its leadership. The job market says, cut interest rates, but tariff-induced inflation says, hold. This deadlock has left the middle class in a high-interest, low-opportunity environment. Furthermore, the 44-day government shutdown in late 2025 shaved up to 0.2 percentage points off annual GDP for every week it lasted, leaving a permanent scar on the economy that the private sector's AI boom is trying to mask. The wealth effect from a strong stock market is only benefiting the top 20% of households, while the bottom 60% struggle with job insecurity and failing sentiment. As the year progresses, the gap between market reality and human reality will only grow. The 2026 anomaly is the ultimate proof that a country can be rich while its people are poor. It is a world of machine productivity, where GDP is a measure of silicon output rather than human flourishing. For the audience of New Era, the warning is clear. The strategies of the past will not work in the agentic era. The quiet revolution of the 1% is complete, and they have moved their assets into the infrastructure of the machines. The 2026 boom is a victory for the algorithm, but for the average worker, it is the most expensive firing in history. The conclusion is inescapable. 2026 is the year the labor productivity link finally snapped. To survive this new era, one must understand that the economy no longer views the human worker as the customer or the creator, but as a bottleneck. As we move toward 2027, The K-shaped divide will likely harden into a permanent class structure of asset owners and the automated. The 2026 anomaly isn't just a market glitch. It is the first page of a new chapter in human history, where the economy finally outgrows the need for the human race. The question for every viewer watching this is simple. Are you an owner of the machines? Or are you just another line of code waiting to be optimized? The data doesn't lie, and in 2026, the data says you are more replaceable than ever before. Welcome to the era of the booming economy and the empty office. Let this be the warning you needed to prepare for what comes next.